Hey everyone, welcome back to the channel. Today, we're diving deep into the fascinating world of economics and monetary policy, where the Federal Reserve has once again decided to keep interest rates unchanged. That's right. Despite some serious pressure from President Trump to cut borrowing costs, the Fed has left its key lending rate sitting comfortably between 4.25% and 4.5%. So, what does this mean for you, me, and the broader economy? Let's break it down. First off, let's acknowledge that this decision was largely anticipated. However, here's where it gets interesting. Two members of the Fed's board actually dissented. That's not just a minor detail. It signals a growing sentiment among policymakers that cutting rates might be necessary. Why? Well, we're grappling with some complex economic indicators here. Now, take a look at the latest data. The U.S. economy grew at an annual rate of 3% during the April-June period. Sounds great, right? But before we get too excited, let's remember that this growth was fueled primarily by a sharp drop in imports due to Trump's tariffs. Yes, those tariffs are playing a significant role in shaping our economic landscape, but at what cost? Jim Thorne, chief market strategist at Wellington Altus Private Wealth, puts it bluntly. Forget about the headline number. He argues that the underlying data suggests an economy that is losing momentum. You see, the Fed typically lowers interest rates when things are tough and raises them if inflation is rising too quickly. Right now, inflation is above their target of 2%, sitting at 2.7%. This makes their task even trickier, especially when you consider that other central banks around the world are making cuts while the Fed stands still. Are they waiting for a clearer picture before taking action? Perhaps, but this cautious approach has its risks. And folks, let's talk about timing. The job market is stable with unemployment at 4.1%, but there are cracks starting to show in job creation. Andrew Hollenhorst from Citi warns us about the danger of waiting too long to respond. If they delay too much longer, those cracks might turn into full-blown issues. Now here comes President Trump. He's not one to hold back his opinions. He's been vocal about how lower interest rates could save money on government debt payments and boost the housing market. In fact, he's even toyed with the idea of firing Jerome Powell. Yes, you heard that right. It's a dramatic move that would break decades of precedent. But Trump isn't backing down. He believes that rates must drop now. He recently tweeted about how way better than expected our economic performance is and urged Powell to act swiftly because no inflation is his mantra these days. But wait, let's dissect that a bit further. While Trump pushes for immediate action, Powell and his team are doing their due diligence, ensuring they don't make hasty decisions based on short-term fluctuations. We have to think critically here. If you look at inflation trends in other countries like the UK or South America, it highlights just how precarious our situation can be. And while consumers are still buying groceries, even opting for branded items over cheaper alternatives, we can't ignore that rising prices are affecting spending habits. So what's my takeaway from all this? The Federal Reserve is treading carefully on a tightrope of economic indicators, balancing growth against inflation and responding to political pressures without losing sight of their core mission, maintaining stability in our financial system. As we move forward, keep an eye on how this plays out. Will we see those interest rates drop in September as many markets expect? Or will Powell remain steadfast in his cautious approach? Whatever happens next will undoubtedly affect us all, from homeowners looking to refinance to businesses seeking loans for growth. Thanks for tuning in today. Don't forget to like and subscribe for more insights into the ever-evolving world of economics and finance. Until next time.